Ajay Kaul is CEO at Jubilant FoodWorks. He's joining us right now on the show. Mr. Kaul, thanks very much for your time. Great to have you here. Prashant this side. Sir, in terms of demand recovery,
thank you.
How are things looking? I want to start with the basic, big, broad point. In the post-earnings call, etc., I don't think there was any optimism in that regard. One didn't see that. It was the same commentary that things have not improved and demand remains soft. I just want you to explain that a little bit.
Yeah, Prashant, that's your favorite question, which you have been posing to me for the last 2-3 quarters, and unfortunately, the answer remains almost the same. You know what? However much we may have, internally tried, lots and lots of innovation, new things from the consumer-facing things as well as internally. Any amount of research that we have done or any amount of consumer feedback that we have taken clearly tells us that there are no significant shifts, statistically significant shifts in the consumer sentiment, which means it's kind of more of the same. I have been saying this for the last 2-3 quarters. Unfortunately, the answer remains the same. And it's also reflective in our same-store growth number. As you see, it is kind of continuing in the same zone, 3%, 3.5%, and so on. While I want to quote it with some optimism also. 2-3 things. One, we continue investing in our business because we have our sights set on 2020 and beyond. And thereby, building this infrastructure of store network. 150 is the number of stores which we did for Domino's last year, and around 20 for Dunkin' Donuts. We intend doing kind of similar number, 130, 140 for Domino's next year, and 20 for Dunkin' Donuts. The kind of investments we are making on factories, we are building one state-of-art, probably the best such facility in Domino's world anywhere in Greater Noida. That's going to get commissioned by March next year. So all that work, and in fact, investments on technology, the online ordering, which is a good 40% of our total deliveries today come through the online medium, and a lot of it is through mobile medium. So investments on that front. Our faith and belief in the consumption story of India, and this is pan-India, this is not just the top 100 cities and all that, is still very much intact. It's just that, there is a bit of protracted, period of consumer sentiment not changing significantly. We do believe, however, that with the 7th Pay Commission impact, which is going to start someday soon, OROP-led monies which will again flow into the system. Monsoons are auguring to be good this time. They are going to have a waterfall or a cascading effect even in the semi-urban and urban areas. We believe all that, and also what the government has been trying to do in terms of creating more jobs, focus on productivity. We believe in a few quarters from now, consumer sentiments will change, improve, and we can expect higher numbers. But sitting right now wherever I am currently, I'm sorry to say that we are not seeing any change in consumer sentiment. Prashant, sorry for that.
No, that's absolutely. Just Mr. Kaul, I was looking at now. I'm going slightly macro, but the point is your business will do very well when consumer sentiment picks up. People have more visibility about incomes, more people come into the workforce and things like that, right? That's the basic underlying big driver. So the latest government data, Labor Department data, shows that in 2015, the number of jobs which were created were the lowest on record since when the data has been starting to be put together. So the Labor Department started putting this data together after the financial crisis in 2008. So this is the lowest number in terms of new job additions since then. The NSSO, of course, publishes data which is 5-yearly. The last one was in 2011-12. That was out of turn. Now, that also kind of, it's slightly dated, but some of the things mentioned in that survey fit in with this Labor Department data, right? Are you worried generally about, about those kind of things, slightly bigger macro overlays, or are you very confident that things will start to get better, more jobs will be created and people will move up, there will be premiumization, etc., etc.? Or you think you'd have to change your business plan per se? The number of people who are coming into the workforce remains, 10 lakhs every month. That's a crore plus every year. So that is not, but where are the jobs? That's the big question.
At an overall macro level, internally, if I were to reflect on our thinking, we are very positive. Whatever, GDP growth, one may try to argue that where is the correlation between that and what is happening in the broad FMCG space, which is the consumer space, and within that the subset is, let's say, food service. The correlation may not be very evident, but GDP growth sustained at that level over a period of time, the efforts the government is trying to make, and things have not changed overnight, which all of us were expecting probably, of job creation and so on, will start showing some impact. A few things which I spoke with respect to, the seventh pay commission monies into the system, the OROP-led monies coming into the system, even a good monsoon this year and probably next year is going to have a waterfall effect. So as far as confidence, see, our investment, the kind of capital expenditure which we do on our stores and on our factories, that is going unscathed. The amount of monies which we are putting behind our brand, especially on the technology side, the kind of monies which is going into the online medium, advertising and so on, is only on the rise. Now all this is stemming out of some strong, deep-founded, confidence in the system that things will spring back. We've also tried to study life stages of pizza, food service, quick service restaurants in various countries, developed markets, and seen what kind of cycles have they gone through. Everything is telling us that it's going to spring back, especially at the stage we are. China is a great example, and I'm a big fan of China in terms of having studied all these trends there. We are confident that things are going to come back. The issue is there's a bit of protracted, what we thought would have happened a few quarters back and is still not visible, and maybe it will take a couple of more quarters, is only dampening the spirits a little bit in the short run. But I think in the long run, it's there, Prashant, I can tell you, and it's going to come. So that's the confidence we have, and that's where all our investments are going behind, and that's where all our energies are going behind after.
No, I mean, absolutely. I mean, and all of us, of course, hope that you succeed, because if you succeed, that also will mean that the underlying economy is doing much better, and things would have turned. So that's what all of us want.
That's right.
But what you're betting on is, of course, the underlying demographics and those bigger things changing for the better, right? I mean, that's essentially your bet over a period of time. Because, if we are looking at...
That's right.
Consumers from traditional sectors like, IT, banking, or the salaried class. These are small, of the total workforce, these are maybe 15-18% of the total workforce is salaried in the country. The rest is all unorganized, small scale, medium scale. Right. So we need things to pick up there. The point is GDP numbers are strong, absolutely, but it seems to be a bit of, as some people have called it, a jobless kind of recovery, which we can't afford.
Absolutely.
Sir, you've lowered your restaurant addition target for financial year 17, right? You said earlier 150 per annum over the last 3 years.
Yes.
Now you're saying 130, 140. So there's not that much of a difference, but you've lowered it.
Yes. Yes. Yeah. The reason is simple. Honestly, cosmetically it may look a bit lower. It's only a word of caution. For 3 years, we have done 150 new openings for Domino's and a number of around 20-25 for Dunkin'. Shareholders' money, return, on investment, payback periods is something which we'll never compromise upon. And what we are realizing is that whatever stores we open, whether it's 150 or 140, they have to be profitable stores. They have to, return on investment has to be within certain defined time periods and so on. Keeping that perspective in mind, there is probably a word of caution there that we can still open around 140 stores, profitable, returning money in defined time frames without diluting the ROC and so on significantly, or ROE so significantly. So don't read too much into it. It is basically the same thing. It's just a word of caution.
Okay, what about Dunkin', sir? I was at the car Dunkin' outlet with my family, and by the way, I've always said the burgers are delicious. But I asked the store manager, what is the occupancy? And it was pretty, at that time the occupancy, of course, was pretty poor. He said, well, it's around this. Must be 30-odd%, 35% kind of occupancy. And we were there on a Sunday. What's the plan there? What are you doing? Is a change in strategy required? What are you looking at?
You know what? See, it's a 3-4-year-old brand in the country. If you look around, there are brands as formidable, as big, probably some bigger, without naming them, which have been in the country for 15, 20 years and are still struggling to make money. So that is a gestation period which any brand goes through. And I'm not trying to make a defensive statement here. But I think Dunkin' Donuts as a brand, if we were to look at any brand's evolution in any market, why alone India, and there are 7-10 axes on which you iterate. For example, what should be your pricing strategy? What should be your overall positioning? People strategy, kind of stores you open, where you open them, the store design, and there are a few others also. I think we have iterated, evolved, and reached meaningful destinations or landmarks on each one of them. So we are quite confident that our journey is like we are kind of getting there. Are stores making money, loads of money? The answer is still no. And the last couple of years, so-called drop in sentiment has not helped. If all that had not happened and the market, let's say, would have been even at a same store level, been growing at 10-15%, Dunkin' Donuts would have been clearly on its path to becoming a profitable brand in a couple of years. So we are confident about its journey, but we are also prudent in terms of the way we take the brand, especially in tough times. You may be aware that we shut 3 of our stores down, last quarter, because we realized that those experiments which we had conducted in those stores clearly proved to us that, those were not the kind of stores we had to do in future. So we have closed 3 most prudently, and we don't shy away from that. And we may probably close down a few more, because in our journey of last 4 years, we have done multiple experiments at the same time, multiple iterations. I think we are getting there. The good news is that, we are positioning Dunkin' Donuts overall as an all-day part food, beverage, and coffee place. And if you look at our sale from 12 o'clock in the afternoon until, let's say, 8, 9 o'clock in the night, it's almost like a tabletop, which means at every hour there is some relevant offering that we have which resonates with the consumer's need states. The only thing is we have to lift this upwards. So we are at it. We are continuously trying to see how we can lift the sales up in a tough environment. It's not easy. Coming specifically to that car experience of yours, the car, store, did start very well. The sales, it has come down a little bit. It must have been an unusual day that on a Sunday, the occupancy was probably only 30-40%. Normally it does much better. But we look at every single store in the country at my level with fine-tooth combs and like hawks. And anyone where experiments are proving that this store is probably not going to do well in future, we take some tough calls on that. And we are not afraid of that. So I think it's at an evolutionary phase where, we are satisfied with the journey so far, but still some experiments going on so that it reaches its final destination in a couple of years.
Got that. Just one last final question. I'm being told to wrap because of the paucity of time. But the fall in promoter shareholding recently caused some concerns. Right. The share price also came off on that day. I'm sure you must have noticed. What is the philosophy there? What are you telling investors?
See, philosophy is very simple. The reasons, are clearly corporate purposes and nothing else, which our promoters have. They have reasons to kind of engage, these funds for some of their other corporate requirements. They have done it in the past also. And but if you remember yesterday's call where Hari Bhartia was asked this question, and he very openly and candidly said that they will always be in the 40s range, they are glued on to this business. This business is very, very important for them. You know, if people are misconstruing this to them having lost interest in this business, the answer is a resounding no. And he said all that in that call. So I would only urge you and your viewers not to read too much into it. They are bingo, they are glued on, and their interest in the levels of business are probably at an unprecedented high, because it's also going through a bit of a tough phase. So don't read too much.
Minimum 40% holding. Mr. Kaul, thanks very much. Good speaking with you. Good luck. Appreciate you joining us